Bitcoin crashed to $80,000 overnight, dragging the entire market down with it. But how much worse can things get? And what exactly happened in Tokyo that may have fueled this bloodbath? Hey everyone, my name is Kaylin. If you're new here, be sure to like, subscribe, and turn on notifications so you never miss our latest content. And as always, nothing in this video is financial advice. I wish you the best of luck in your crypto ventures. Good morning, guys. Unfortunately, Bitcoin continues to sell off. Last Friday, I mentioned that I was exiting altcoins as we approached the 50-week EMA, this line here around $100,000. We began losing that level, and historically, losing this EMA marks the end of bull markets, especially when 2 weekly candles close below it. We already closed the first weekly candle last week, and now we have about 2 days and 11 hours left until the next close. We're down roughly 20% from that point, and things aren't looking great right now. But I'm going to break down several reasons we could see a potential pump in the next month or two. It's the next major support zone, as previous all-time highs flipped into support. This big blue box between roughly $71,000 and $78,000 is the next key support area. We already got close, wicking down to about $80,000 overnight before bouncing this morning, which makes sense after a week of nearly straight downward movement with no real bounces. Let's get into the reasons behind this move. First, for perspective, when FTX collapsed, the fear and greed index hit 12. Now we're sitting at 9 at $91,000. Yesterday's reading was even lower than during the FTX crash, when Bitcoin was trading at $21,000. The fear is extreme. Next, Shinaka reports. The global financial system just broke in Tokyo. Japan's 30-year bond yield hit 3.41% today. The number might seem meaningless, but here's why it should terrify you. Japan owes 230% of what it produces, the most indebted nation in human history. For 35 years, it kept the lights on by borrowing at near zero rates. That era ended this morning. Here's what happened. Core inflation is running at 3%. Government bond yields are hitting levels not seen since 1999. China has already conducted its 25th military incursion near Japanese waters this year. Japan is forced to spend 2% of its GDP on defense, nearly 9 trillion yen annually. The Bank of Japan is stuck between two impossible options: raise rates and trigger a debt collapse, keep rates low and let inflation destroy savings. They chose the second option. Why this matters. Every major bank, hedge fund, and institution has been borrowing cheap yen and investing elsewhere, known as the yen carry trade, for 30 years. This could be worth $350 billion to $4T, but nobody knows the exact number because much of it is hidden in derivatives. When Japan's system breaks, this money unwinds fast. We've seen this before. In July 2024, the Nikkei dropped 12.4% in a single day, and the Nasdaq fell 13%. That was just a tremor. The earthquake is still coming. Japan pays interest on $90 of debt. Every 0.5% increase in rates costs them $45 billion annually. At current yields, debt servicing will consume 10% of all tax revenue, the death buyer threshold. The yen trades at 157 per dollar. If it strengthens to 152, the entire carry trade becomes unprofitable. That triggers forced unwinds. Emerging market currencies could fall 10 to 15%, and the Nasdaq could drop 12 to 20% as funds are forced to sell. The Bank of Japan meets December 18th to 19th. Markets give a 51% chance of a 0.25% rate hike. If they raise, volatility explodes. If they don't, inflation worsens. There is no way out. Japan must keep the yen weak to service its debt. This means global free money that has powered markets since 1990 is ending. Worldwide interest rates will rise 0.5 to 1% permanently, not because of inflation, but because the world's largest credit engine is seizing. Mortgages, car loans, credit cards, all repricing higher. Stock valuations will compress. The everything bubble is deflating. This isn't a recession, it's a regime change. A liquidity engine just shut down, and most people won't understand why their portfolios dropped 30% until after the fact. Tokyo broke the world today, and the impact will be felt tomorrow. There's a lot there, but the short version is this. It's similar to last year's sell-off when Bitcoin fell toward $49,000 as the yen carry trade unwound and fear peaked. I think we're close to that peak fear moment again. If Bitcoin retests $75,000, I expect some kind of bounce. We're deeply oversold, sentiment is max fear, and the market rarely continues straight down forever. Next, Mike Alford reports that several senior banking executives called Fed Chair Jerome Powell to express concerns over Japan's monetary policy and the urgent need for early rate cuts and a return to large-scale QE. Meanwhile, Jacob notes that Nakamoto's Naka just dumped 367 BTC, over $35 million. We're entering the phase where treasury companies who bought Bitcoin are facing big losses and will be forced to dump. This bear market could be worse than previous ones. Many digital asset treasury companies and mining firms are now selling. Unlike retail, they cannot hold to zero. They have investors and obligations. This is partly why we're seeing cascading sell pressure. Next, Sightbringer analyzes the strange 9:30 a.m. Binance seller pattern. For 2 weeks, a single actor or tight cluster aggressively sold Bitcoin at exactly 9:30 a.m. Eastern Standard Time, New York Open, with the same size, same timing, same execution on Binance futures. That never happens by accident. It's systematic, mandated, professional flow, not retail, not typical whale behavior. He outlines 4 possibilities. A. Structured unwind, a desk-cutting risk. B. Hedging schedule, fixed-time hedging. C. Coordinated desks, shared liquidity window. D. Disastrous actor unwinding a bad position. Importantly, this does not look like a healthy seller. Healthy selling doesn't dump into thin books, into falling price, during volatility spikes, or at the exact same time daily with zero sensitivity to slippage. This seller is constrained, forced, and cleaning up a mess, not expressing a bearish view. This behavior aligns with the October 10th liquidity fracture, shallow depth, ETF redemptions, stressed Bitcoin liquidity, weaker market makers, and whales absorbing supply. It points to damaged microstructure and forced flow, not new bearish fundamentals. Tonley backs this up, explaining that the October 10th liquidation shock crippled market makers, who function almost like crypto's central banks.
Crypto market has been limping along since October 10th because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Then there's Cardano founder Charles Hoskinson, who still believes Bitcoin will reach $250,000 by the end of 2026. Despite macro challenges, he expects most downside to clear in the next 2 quarters.
And crypto's not immune to the macro. We're still dealing with issues from the tariffs. We're still dealing with a great degree of economic uncertainty. Just this year was a little lackluster, but overall, I'm still very optimistic in the next 12 months. I think we'll clear most of this downside the next 2 quarters, and we'll be back up to $250,000 Bitcoin by the end of 2026.
Finally, Lark Davis highlights massive liquidity coming. A reported plan for President Trump to distribute $2,000 checks. Japan preparing a $110 billion stimulus. China issuing a $1.40 stimulus. the US issuing $1.9t in treasuries annually, the Fed nearing the end of QT, Canada beginning QE again. Global M2 money supply at record highs. This is the counterargument. Once forced selling ends and new liquidity hits the system entering the new year, a major rebound is possible. We could still see more pain first, but this may be a rough in-between phase, similar to mid-2021 when Bitcoin fell from $65,000 to $30,000, then later returned to $65,000. It doesn't guarantee a Q1 recovery, but it keeps the bull market is over narrative in question. Lastly, Falcon Finance has launched staking vaults designed for productive holding. These vaults let long-term holders maintain exposure to their assets while earning yield paid in USDF, a synthetic dollar for stable on-chain use. Interest in passive, dependable on-chain income is rising. Falcon already offers classic yields, stake USDF for FF tokens, and boosted yields, lock USDF or SUSDF for higher returns. The new staking vaults add a third option. Users can stake tokens they already hold and earn USDF, while maintaining full exposure to price movement. The first supported token is FF, Falcon's governance and utility token. That's Falcon Finance's latest update. Right now, Bitcoin is hovering just above $84,500. Thanks for watching. Stay safe out there, and I'll see you next time.